What if I told you that a professional dancer with no formal financial education beat Wall Street at its own game and walked away with $2 million? No hedge fund, no insider tips, no MBA, just discipline, patience, and a system so simple most investors ignored it. This is the true story of Nicolas Darvas, a man who spent most of his time performing on stage while quietly placing stock trades from hotel rooms around the world. In the 1950s, long before apps, charts, or YouTube gurus, Darvas turned a modest bankroll into a fortune by doing the exact opposite of what the crowd was doing. While Wall Street obsessed over news, rumors, and predictions, Darvas focused on price action. While investors chased hot tips, he waited. While fear and greed destroyed portfolios, he followed rules no matter how boring they seemed. And those rules changed everything. This book isn't about getting rich overnight. It's about learning how markets really move, why most people lose money even when they're right, and how emotional decisions silently destroy long-term wealth. Darvas didn't win because he was smarter. He won because he was more disciplined than everyone else. Inside this story, you'll discover why news is often your worst enemy as an investor, how Darvas' famous box theory helped him cut losses fast and let winners run, the psychological traps that cost him hundreds of thousands, and the rules that saved him millions, and the timeless investing lessons that still work today, decades later. This isn't just a book about stocks. It's a lesson in self-control, patience, and trusting a system when emotions are screaming at you to quit. So if you've ever wondered why investing feels so hard, or why smart people still lose money, this story might change how you see the market forever. Chapter 1 introduces Nicolas Darvas before he ever became a successful investor. At this stage of his life, he is not a market expert, not a strategist, and not even particularly interested in stocks. He is a professional dancer, traveling internationally, earning high income from performances, and living a fast-moving, unconventional life. Darvas' first exposure to the stock market happens almost by accident. While working in Canada, Darvas is offered stock shares as partial payment for a business deal. He doesn't choose the stocks. He doesn't research them. He accepts them simply because they are offered and because he assumes they must be valuable. This moment is important because it mirrors how many beginners enter the market without a plan, without knowledge, and without understanding risk. At first, things go well. The stocks rise in price, and Darvas watches his paper profits grow. This early success gives him confidence, but it's false confidence. He hasn't earned these gains through skill or analysis. He doesn't even understand why the stocks are moving. Still, like many first-time investors, he assumes that making money means he must be doing something right. Then reality hits. Without warning, the same stocks that had been rising begin to fall sharply. Darvas has no system to tell him when to sell, no rules to protect his capital, and no emotional discipline. He reacts the way most inexperienced investors do. He hesitates. He waits. He hopes the price will come back. It doesn't. By the time he finally sells, much of his profit is gone. This loss shocks him not because of the money, but because he realizes something critical. The market doesn't care about hope, logic, or intention. Prices move based on forces he doesn't yet understand. Instead of walking away, Darvas becomes curious. He begins asking questions. He talks to brokers. He reads financial publications. He tries to understand how professionals operate. What he discovers frustrates him. Every expert has a different opinion. One broker says buy, another says sell. Analysts argue endlessly, yet no one can explain with certainty what will happen next. This confusion leads to Darvas' first major insight. He realizes that most people in the market are guessing, even if they sound confident. Predictions are often disguised as expertise, and the more opinions he hears, the worse his decisions become. The noise makes him emotional, and emotion makes him lose money. During this Canadian period, Darvas also learns an early lesson about time and distance. Because he is traveling constantly, he cannot monitor the market closely. Ironically, this limitation protects him. He notices that when he interferes less, his results improve. When he checks prices constantly, fear and greed push him into bad decisions. This experience plants the seed for a critical idea. less action can lead to better outcomes. By the end of Chapter 1, Darvas is still far from successful. He hasn't developed the box theory yet. He hasn't built a system. But something important has changed. He no longer believes that intelligence, tips, or insider information are enough. He understands that the stock market is not a place for opinions, it is a place for rules. Chapter 1 sets the foundation for everything that follows. It shows Darvas as a beginner making classic mistakes, trusting luck, following advice blindly, and letting emotions control decisions. More importantly, it shows the moment he begins to think differently, not as a dancer playing the market, but as a student preparing to build a method that removes emotion and replaces it with discipline. This is the starting line of his transformation. In Chapter 2, Nicolas Darvas officially steps deeper into the world of Wall Street, but not as a confident investor. Instead, he enters the market confused, overloaded with information, and increasingly dependent on experts. After his early experience in Canada, Darvas believes the logical next step is to learn from professionals. He assumes that Wall Street insiders, brokers, and analysts must understand how the market truly works. If he can access their knowledge, he thinks consistent profits should follow. This assumption turns out to be one of his biggest early mistakes. Darvas opens brokerage accounts and begins taking advice seriously. He listens closely to recommendations, follows analyst reports, and reacts to market news. Every decision now feels informed, but instead of improving his results, his performance gets worse. The core problem is overload. Each broker has a different opinion. One recommends buying on growth. Another warns of an imminent crash. Newspapers publish confident forecasts that contradict each other daily. Darvas notices that no one agrees, but everyone sounds certain. This creates a dangerous loop. The more opinions Darvas consumes, the more uncertain he becomes. Instead of acting decisively, he hesitates. Instead of following logic, he reacts emotionally. When stocks rise, he becomes greedy and buys late. When they fall, he becomes fearful and sells at the wrong time. For the first time, Darvas realizes something unsettling. Access to information does not equal clarity. In fact, the information makes him worse. He begins to notice a pattern in his losses. Stocks he buys based on recommendations often peak shortly after he enters. By the time he feels confident enough to buy, the move is already over. When prices decline, the same experts encourage patience right until the losses become painful. This leads Darvas to a critical insight. Most advice is reactive, not predictive. Wall Street doesn't lead the market. It explains the market after prices have already moved. Another important lesson in this chapter is Darvas' growing awareness of emotional damage. He realizes that his biggest losses don't come from bad stocks but from bad reactions. Fear, hope, and ego quietly dictate his decisions. He also recognizes a conflict between his lifestyle and the way Wall Street operates. As a traveling dancer, Darvas cannot watch the market constantly. He cannot react minute by minute. Initially, he sees this as a disadvantage, but gradually, he notices something surprising. When he is away and unable to trade frequently, his losses are smaller. Distance reduces emotion. This observation challenges the traditional belief that successful investing requires constant attention. Darvas begins to question whether less involvement might actually produce better results. By the end of Chapter 2, Darvas reaches a turning point not in strategy, but in mindset. He no longer trusts forecasts. He no longer believes experts know the future. And he no longer assumes that intelligence alone leads to profits. Instead, he begins searching for something different, a method that does not rely on opinions. He doesn't have that method yet, but the direction is clear. Chapter 2 shows Darvas transitioning from a hopeful beginner into a skeptical student of the market. He hasn't found success, but he has identified the real enemy: noise, emotion, and blind trust in authority. This chapter sets the stage for what comes next. Darvas is about to stop asking, "What do people think will happen?" and start asking a far more important question: what is the market actually doing? That question will eventually lead to the system that changes everything. Chapter 3 marks Nicolas Darvas' first real crisis as an investor. This chapter is important because it shows the moment when small mistakes turn into serious consequences, and when Darvas begins to understand how dangerous emotions can be in the stock market. Up to this point, Darvas has been experimenting. He has made money, lost money, and followed advice without a system. But in this chapter, the stakes become higher. His positions are larger, his confidence is stronger, and the losses are no longer just uncomfortable, they are alarming. The crisis begins when several stocks Darvas owns start to decline sharply. Instead of acting quickly, he hesitates. He remembers brokers telling him that good stocks always come back, and that temporary drops are normal. So he waits. This waiting is not strategic, it is emotional. As prices continue to fall, Darvas feels trapped. Selling would mean admitting he is wrong. Holding gives him hope that the market will reverse. Like many investors, he chooses hope over action. The result is predictable. Losses grow larger, and Darvas finds himself checking prices constantly. Every market movement affects his mood. When prices rise slightly, he feels relief. When they fall again, anxiety returns. He realizes that the market has begun to control his emotions, not the other way around. At this stage, Darvas also becomes aware of another dangerous habit: averaging down. Instead of cutting losses, he buys more shares at lower prices to reduce his average cost. On paper, this looks logical. In reality, it increases risk and deepens his emotional attachment to losing positions. This behavior only makes the situation worse. Eventually, Darvas is forced to sell some of his stocks at a significant loss. The experience is painful, but it produces one of the most important realizations of the book. Losses are not the real problem, uncontrolled losses are. Darvas begins to reflect on his behavior during the crisis. He notices that he never defined in advance how much he was willing to lose. He entered trades without exit rules. Every decision was made after the market moved, not before. This realization leads him to a critical conclusion. If you don't decide your exit point in advance, the market will decide it for you, and it will not be kind. Another key lesson in this chapter is Darvas' growing distrust of explanations. After the losses, analysts and brokers provide reasons for why prices fell. But Darvas notices something troubling. These explanations always come after the fact. They do nothing to prevent losses. He starts to question the value of understanding why a stock moves, if that understanding cannot protect capital. By the end of Chapter 3, Darvas is mentally exhausted. He is disappointed in the experts, frustrated with himself, and increasingly aware that knowledge alone is not enough. What he lacks is a clear set of rules. This crisis becomes a turning point. Darvas accepts that he cannot predict the market, he cannot control prices, and he cannot rely on opinions, his own or anyone else's. What he can control is risk. The chapter ends with Darvas committed to one idea that will shape everything that follows. Capital preservation comes before profit. Without strict rules for cutting losses, no strategy can survive. This realization pushes him toward building a system that removes emotion, defines risk clearly, and forces discipline even when fear and hope are strongest. Chapter 3 is not about success. It is about failure used correctly. Darvas' first crisis teaches him the lesson that most investors learn too late. You don't lose money because you're wrong, you lose money because you stay wrong for too long. This lesson becomes the foundation of his future success. Chapter 4 is one of the most important chapters in the entire book. This is where Nicolas Darvas begins to develop the system that will later make him millions. The chapter is not about sudden success, it is about trial, observation, and rule building based on real market behavior. After his first crisis, Darvas becomes obsessed with one question: how can I participate in the market without being controlled by emotion? He decides to stop listening to opinions and start studying price movement itself. Darvas begins analyzing stock charts, not to predict the future, but to understand patterns. He notices that many stocks do not move randomly. Instead, they often trade within clear price ranges for extended periods of time. A stock rises to a certain level, then stalls. It falls to a lower level, then stops falling. Between these two levels, price moves back and forth. Darvas visualizes this behavior as a box. The top of the box represents resistance where selling pressure appears. The bottom represents support where buying pressure appears. This observation becomes the foundation of what he later calls the box theory. Instead of asking why a stock is moving, Darvas focuses on where it is moving. If a stock breaks above the top of the box on strong volume, he interprets this as a signal that demand has overwhelmed supply. This is when he becomes interested in buying. Just as important is the downside rule. If a stock falls below the bottom of the box, Darvas sees this as proof that he is wrong. He sells immediately, no hesitation, no hope, no explanations. This rule is critical. Darvas is no longer trying to avoid losses. He is trying to control them. Another key development in this chapter is his growing respect for volume. Darvas notices that breakouts without volume often fail. But when price breaks above a box with unusually high trading volume, the move is more likely to continue. Volume becomes confirmation. Darvas also limits his universe of stocks. He avoids cheap, inactive names and focuses on stocks making new highs. This goes against common advice at the time, which encourages buying bargains. Darvas concludes that stocks reaching new highs are doing so for a reason. Institutions are accumulating them. This insight pushes him further away from traditional thinking. He is no longer interested in undervalued stocks. He is interested in stocks under accumulation. During this chapter, Darvas emphasizes how difficult it is to follow rules emotionally. Even with a clear system, fear and greed constantly tempt him to act early, exit late, or ignore his stop-loss rules. Several early attempts with the box theory fail not because the system is wrong, but because Darvas breaks his own rules. This reinforces another lesson. A system only works if it is followed exactly. Gradually, as Darvas becomes more disciplined, results begin to improve. Losses become smaller and faster. Winning trades are allowed to grow. Most importantly, his emotional stress decreases. He no longer feels the need to monitor every market move. The system gives him psychological distance. By the end of Chapter 4, Darvas does not claim to have found a perfect strategy. What he has developed is something more valuable, a rule-based framework that removes opinion, prediction, and emotion from decision-making. This chapter represents the shift from gambling to methodology. Darvas is no longer trying to outthink the market. He is learning to listen to it. The box theory becomes the core structure around which all his future success is built. Chapter 5 shows how Nicolas Darvas begins to apply the box theory in real market conditions, while facing a major practical challenge: distance. As a professional dancer touring internationally, Darvas is often thousands of miles away from Wall Street. He cannot watch prices daily, react quickly, or speak frequently with brokers. Instead of seeing this as a weakness, Darvas learns to turn distance into an advantage. Because he is constantly traveling across Europe, Asia, and South America, Darvas relies on cable telegrams to receive price updates. These messages are delayed, expensive, and limited. He cannot overtrade. He cannot react emotionally to every market fluctuation. This limitation forces discipline. Darvas structures his trading so that decisions are made in advance. He defines his buy points, his box levels, and most importantly his stop-loss levels before placing trades. Instructions are sent to his broker clearly and mechanically. If price breaks out above the box, buy. If price falls below the box, sell. No interpretation, no exceptions. This approach removes impulse entirely. In this chapter, Darvas begins to experience consistent improvement in his results. Losses are small and controlled. When trades fail, he exits automatically. When trades succeed, he allows them to run without interference. He notices that many of his best-performing stocks continue rising, while he is completely disconnected from the market. This reinforces a key belief: constant monitoring is not required for success, discipline is. Another important development in Chapter 5 is Darvas' refinement of stock selection. He narrows his focus further to stocks making new highs with strong volume, particularly those supported by institutional buying. He avoids rumors, tips, and news-driven ideas entirely. Darvas also begins keeping detailed records. He tracks entry prices, box ranges, volume behavior, and outcomes. Over time, patterns become clear. Trades that follow the rules work more often. Trades where he bends rules fail more often. The evidence strengthens his confidence not in predictions, but in process. Emotionally, this chapter marks a major shift. Darvas feels calmer. The anxiety that once dominated his trading begins to fade. He no longer feels pressure to be right. His only responsibility is to follow the system. One of the most important lessons in this chapter is Darvas' realization that distance protects objectivity. When he is physically close to the market, temptation increases. When he is far away, the system operates cleanly. This leads him to an unconventional conclusion. The less involved the investor is emotionally, the better the results tend to be. Darvas also becomes more comfortable with being wrong. Small losses no longer bother him. They are simply part of the system. What matters is that no single loss can damage his capital significantly. By the end of Chapter 5, Darvas is no longer experimenting. He is executing. The box theory is no longer theoretical, it is operational. It works across time zones, across countries, and without constant supervision. The system does not depend on intelligence, news, or market opinions. It depends only on price behavior and discipline. Chapter 5 demonstrates that Darvas' success is not based on being close to Wall Street, but on being independent from it. This chapter reinforces a core principle of the book. A good system should work even when you are not watching it. From this point forward, Darvas is no longer learning whether his method works. He is learning how far it can take him. Chapter 6 places Nicolas Darvas in a much more difficult environment, a declining market, which he refers to as a baby bear market. This chapter tests whether the box theory can survive when conditions are no longer favorable, and optimism disappears. Up to this point, Darvas has begun to see success. His system works during rising markets. But now the broader market starts to weaken. Many stocks fail to break out. Others break out briefly, then reverse sharply. This is where most investors lose discipline. Darvas notices that during market downturns, fear spreads faster than logic. Prices become unstable. Breakouts fail more frequently. Losses increase across the board. For many traders, this leads to emotional reactions, abandoning systems, chasing rebounds, or trying to predict bottoms. Darvas chooses a different approach. Instead of adjusting his system emotionally, he doubles down on rule enforcement. He accepts that in a bear phase, losing trades will happen more often. His goal is no longer to maximize profits but to protect capital. The box theory gives him a clear advantage here. When stocks fail to hold above their boxes, Darvas exits immediately. He does not argue with the market. He does not justify holding based on long-term potential. If price violates the lower boundary of the box, the position is closed. As a result, his losses remain small and controlled, even though they are more frequent. This chapter highlights a crucial distinction Darvas makes. There's a difference between being wrong often and losing a lot of money. Darvas is wrong many times during this period, but each time, the cost is limited. Another important lesson in this chapter is Darvas' refusal to fight the market trend. He observes that during a baby bear market, very few stocks are capable of sustained advances. Instead of forcing trades, he reduces activity. He waits. This patience is difficult. Emotionally, inactivity feels like failure. But Darvas understands that capital preservation during bad markets is what allows long-term success. He also notices that many investors around him behave differently. They increase trading activity, chase falling stocks, and look for bargains. Darvas concludes that this behavior is driven by ego, the need to be right, active, and involved. His system removes that need. Another key observation in Chapter 6 is the importance of market environment. Darvas accepts that no system performs equally well in all conditions. The goal is not to avoid drawdowns entirely, but to ensure they do not destroy capital or confidence. By strictly following his rules, Darvas survives the baby bear market with discipline intact. While many investors suffer large losses, he remains financially and psychologically stable. Emotionally, this chapter represents growth. Darvas is no longer shaken by losses. He no longer feels urgency to recover money quickly. He understands that patience is part of the strategy. The market does not reward constant action, it rewards correct action at the right time. Toward the end of the chapter, Darvas begins to see early signs of improvement. Some stocks start forming clean boxes again. Volume behavior improves. Breakouts become more reliable. Because he preserved capital and confidence, he is ready to act when conditions improve. Chapter 6 reinforces one of the most important lessons of the book. The real enemy is not the bear market, it is undisciplined behavior during the bear market. Darvas proves that a rule-based system does not eliminate losses, but it prevents disaster. This chapter shows that survival is a skill, and survival is what allows future success. By the end of Chapter 6, Darvas has passed a critical test. His system works not because it wins all the time but because it keeps him in the game. When others are forced out, this prepares him for the next phase, where discipline meets opportunity. Chapter 7 marks the moment when Nicolas Darvas begins to see clear, repeatable success. This is not a lucky streak. It is the result of disciplined execution of the box theory under improving market conditions. After surviving the baby bear market, Darvas notices a shift. The overall market environment begins to strengthen. More stocks start forming clean price patterns. Breakouts occur with stronger volume and follow through. This is the environment his system was designed for. Darvas does not change his method. He does not become more aggressive emotionally. Instead, he applies the same rules, but now the market starts rewarding them. Stocks that break above their boxes continue moving higher. Darvas adds positions gradually, always after confirmation. He raises stop-loss levels as new boxes form at higher prices, locking in profits while allowing room for continued growth. This chapter shows how the box theory scales. As prices rise, Darvas does not sell simply because he has made money. He sells only when price violates the structure. This allows winners to run much longer than he ever allowed before. One of the most important changes in this chapter is Darvas' relationship with profit. Previously, profits made him nervous. He feared losing them and sold too early. Now, profits are treated the same way as losses, managed by rules. Emotion is removed from both sides of the trade. Another critical element in Chapter 7 is Darvas' increasing confidence in price over opinion. While analysts and newspapers debate economic conditions, Darvas ignores the noise. His only focus is whether price confirms strength. If price and volume agree, he stays invested. If price breaks down, he exits. This simplicity is powerful. Darvas also begins to recognize the importance of position sizing. As his account grows, he increases position sizes carefully, still respecting risk limits. No single trade is allowed to threaten his overall capital. This prevents overconfidence. Throughout the chapter, Darvas emphasizes that success does not come from being right often. Many trades still fail. The difference now is that losses are small and quick, while gains are large and allowed to compound. This asymmetry changes everything. Emotionally, Darvas feels different. He is no longer anxious about daily price movements. He no longer feels the urge to intervene. The system operates whether he is watching or not. This detachment is not accidental, it is designed. Darvas also observes that many investors around him are struggling, even as the market improves. They hesitate to buy because of past losses. They sell too early because they don't trust rallies. Darvas understands why. Without a system, confidence is fragile. His confidence is not based on prediction. It is based on procedure. By the end of Chapter 7, Darvas reaches an important conclusion. The market rewards discipline when conditions are right, but only for those who are prepared. This chapter proves that the box theory is not theoretical. It works in real markets. With real money, over multiple trades, Darvas has moved beyond experimentation. He is now executing a strategy with consistency. Chapter 7 represents the transition from survival to growth. Darvas is no longer focused on avoiding failure. He is focused on allowing success to compound without interference. This chapter sets the stage for the dramatic financial results that follow. The system is working, the market is cooperating, and Darvas is disciplined enough not to sabotage himself. From here on, the question is no longer whether the method works, but how far it can go when followed without compromise. Chapter 8 marks a major financial milestone for Nicolas Darvas, his first $500,000 in profits. However, the chapter is not written as a celebration. Instead, Darvas uses this phase to explain how success itself becomes a new psychological challenge and how discipline must increase as money grows. By this point, the box theory is working consistently. Darvas is trading stocks making new highs, breaking out of well-defined boxes with strong volume. He is no longer experimenting. He is executing the same rules repeatedly across multiple positions. The difference now is scale. As his account grows, the dollar value of each price movement becomes emotionally heavier. A small percentage fluctuation now represents tens of thousands of dollars. Darvas acknowledges that this creates a new kind of pressure, one that tempts him to interfere with winning trades. This is where many investors fail. Darvas feels the urge to protect profits prematurely. The fear of giving back gains is stronger than the fear of small losses. But instead of changing his system, he recognizes this emotion as a threat and chooses to tighten discipline, not loosen it. He continues to let winners run until price action tells him otherwise. One of the most important lessons in this chapter is Darvas' realization that profits must be managed the same way as losses, with rules, not emotions. Selling simply because a position shows a large gain is no different from holding a losing position out of hope. Both are emotional decisions. Darvas also becomes more selective. With larger capital, mistakes become more expensive. He avoids marginal setups and focuses only on the cleanest box formations, fewer trades, higher quality. This selectivity improves results further. Another key theme in Chapter 8 is public attention. As Darvas' success grows, he attracts interest from brokers, analysts, and observers. People begin offering advice again. Some praise his results. Others warn him that he has been lucky and that a correction is coming. Darvas ignores all of it. He has learned that outside opinions are most dangerous when confidence is high. He refuses to let praise weaken his discipline or criticism shake his rules. His system does not change based on account size or public opinion. Throughout this chapter, Darvas emphasizes that his success is not due to predicting market tops or bottoms. He does not know how high a stock will go. He only knows when he is wrong, and that knowledge protects him. This mindset allows compounding to work. Another important development is Darvas' growing acceptance of volatility. Large gains are never smooth. Stocks move in waves, form new boxes, consolidate, and then break out again. Darvas allows this process to unfold without interference. He no longer confuses normal pullbacks with failure. Emotionally, Chapter 8 shows Darvas reaching a new level of maturity. He is not excited by profits. He is focused on execution. Success does not change as behavior rules do. By the end of the chapter, Darvas reaches the $500,000 mark, but he treats it as a checkpoint, not a finish line. He understands that the same behaviors that built this success must continue unchanged, or the gains can disappear just as quickly. Chapter 8 reinforces a critical lesson of the book. Making money is easier than keeping the mindset required to continue making money. Darvas proves that discipline must scale faster than capital. The box theory works not because it creates profits, but because it prevents emotional sabotage. As profits grow, this chapter sets the stage for the final stretch of the journey, where the numbers get larger. The pressure increases, and the margin for error becomes even smaller. From here on, Darvas is not just managing trades. He is managing himself. Chapter 9 introduces Nicolas Darvas' second major crisis, and this one is far more dangerous than the first. Unlike earlier failures, this crisis does not come from ignorance, it comes from success, confidence, and subtle rule breaking. By this stage, Darvas has already achieved significant profits. His system works. His confidence is justified. But this is precisely what makes the situation risky. The crisis begins when Darvas starts to bend his own rules. He still uses the box theory, but not with the same precision. In some cases, he enters trades slightly early. In others, he delays selling when a stock violates its box. The violations are small, but they matter. Darvas believes he understands the market better now. He feels capable of making judgment calls. This is the trap. During this period, several of his large positions begin to behave unpredictably. Breakouts fail. Prices reverse quickly, Instead of exiting immediately, Darvas hesitates. He rationalizes. He tells himself the market is only reacting temporarily. The result is sharp drawdowns. What makes this crisis more serious than the first is scale. Losses that would have been minor earlier now represent tens or hundreds of thousands of dollars. The emotional pressure is intense. Darvas realizes something disturbing. Even a proven system cannot protect you if you stop respecting it. Another important factor in this chapter is external interference. As Darvas becomes more visible, he is exposed again to opinions, praise, warnings, and predictions. Some people suggest he has peaked. Others urge him to be more aggressive. He listens just enough to create doubt. This hesitation leads to inconsistent execution. Some trades are managed strictly, others are not. The lack of uniformity produces uneven results and growing frustration. Darvas begins to feel emotionally connected to outcomes against something his system was designed to eliminate. The crisis reaches a peak when Darvas realizes that his recent losses are not caused by market conditions, but by himself. The system did not fail, discipline did. This realization is painful but necessary. Darvas takes a step back and conducts an honest review of his trades. He compares positions where rules were followed exactly to those where he intervened emotionally. The pattern is unmistakable. Rule-following trades behave as expected. Rule-breaking trades produce damage. From this point, Darvas makes a critical decision. No exceptions, no discretion, no interpretation. He recommits fully to the box theory as a mechanical system. He stops anticipating breakouts. He stops giving stocks extra room. He exits immediately when price violates structure, regardless of profit size or emotional attachment. Another key lesson in Chapter 9 is Darvas' acceptance that drawdowns are unavoidable. But catastrophic losses are optional. Systems are not meant to prevent losing periods, they are meant to prevent ruin. Emotionally, this chapter represents humility. Darvas accepts that success does not make him smarter than the market. It only proves that rules work when followed. The moment ego enters, risk increases. By restoring discipline, Darvas stabilizes his performance. Losses slow. Confidence returns, not emotional confidence, but procedural confidence. He understands now that the most dangerous phase for any investor is after success, not before it. Failure teaches caution. Success tempts overconfidence. Chapter 9 reinforces one of the most important messages of the book. Your greatest enemy is not the market, it is your willingness to bend rules when results are good. Darvas' second crisis is not about losing money, it is about almost losing control. By surviving it, he reaches a higher level of maturity as an investor. He no longer believes that experience grants permission to improvise. Experience, instead, demands stricter discipline. This chapter prepares Darvas for the final phase of his journey where absolute rule following, scale, and emotional neutrality combine to produce extraordinary results. From here on, there is no room left for interpretation, only execution. Chapter 10 is the conclusion of Nicolas Darvas' journey and the final proof that his method works. When applied with absolute discipline at scale, this chapter is not about discovering anything new. It is about executing the same rules flawlessly while managing large capital, high pressure, and public attention. By this point, Darvas' account has grown dramatically. He is trading with significant size, and small price movements now translate into large dollar changes. Despite this, his behavior does not change. This is the defining feature of the chapter. Darvas emphasizes that his success does not come from increased intelligence or better predictions. It comes from refusing to adapt emotionally to larger numbers. The box theory remains unchanged. He continues to focus only on stocks, making new highs with strong volume. He buys only after confirmed breakouts. He exits immediately when price breaks below the box. There are no exceptions, not for famous stocks, not for large profits, not for personal conviction. This consistency allows compounding to accelerate. As winning trades continue to form higher boxes, Darvas moves his stop-loss levels upward. Profits are protected mechanically. He does not guess tops. He allows the market to decide when the trend is over. One of the key themes in this chapter is emotional neutrality. Darvas explains that once a system is proven, The investor's job is no longer analysis, it is obedience. Thinking, interpreting, or improvising only increases risk. His trades are no longer ideas, they are executions. Another important point in Chapter 10 is Darvas' detachment from identity. He does not see himself as a genius, a guru, or a market expert. He repeatedly stresses that the market remains stronger than any individual. His success comes from submission to market rules, not domination. This humility protects him. Darvas also addresses public reaction. As his results become known, opinions intensify. Some praise him, others criticize his approach, calling it mechanical or simplistic. Darvas ignores all commentary. He understands that outside opinions have no statistical value. Throughout the chapter, Darvas reinforces that his method is not about prediction. He does not know when the market will top. He does not know which stock will be the best performer. His edge comes from reacting faster than others when price confirms or denies strength. Risk management remains the priority. Even at this stage, Darvas accepts losses without hesitation. Losing trades still occur. The difference is that winners are now much larger than losers, and capital is protected at every stage. Eventually, Darvas reaches the milestone, $2 million. He does not describe this moment emotionally. There is no excitement, no celebration. Instead, he treats it as the logical result of following rules over time. The number itself is not important, the process is. The final lesson of Chapter 10 is clear and uncompromising. Markets do not reward intelligence. They do not reward opinions. They reward discipline, patience, and risk control. Darvas makes it clear that his success is reproducible not because the market repeats exactly, but because human behavior repeats. Fear, greed, and ego remain constant. A system that controls these forces remains effective. The book ends with Darvas stepping away from active trading, not because the system stopped working, but because he achieved his goal. He leaves with the understanding that the market will always be there, but capital and discipline must be preserved. Chapter 10 closes the journey by reinforcing the book's central message. Success in the stock market is not about finding the perfect stock. It is about becoming the kind of person who follows rules when it matters most. Darvas' $2 million are not the result of brilliance. They are the result of consistency without compromise. And that is the final lesson of the book. How I Made $2 Million in the Stock Market is not a story about luck, intelligence, or secret information. It is a case study in discipline, structure, and emotional control. Across 10 chapters, Nicolas Darvas proves a simple but uncomfortable truth. Most investors fail not because they don't know enough, but because they cannot follow rules under pressure. Darvas starts as a complete outsider. He makes every beginner mistake, chasing tips, listening to experts, holding losses, selling winners too early. What changes his trajectory is not better predictions, but a shift in focus from opinions to price behavior. The box theory becomes a solution. It removes guessing. It defines when to enter, when to exit, and how much to risk. Most importantly, it forces Darvas to accept small losses quickly and allow winners to grow without interference. The book makes one point over and over again. The market does not reward effort, intelligence, or conviction. It rewards consistency. Darvas succeeds because he treats trading like a system, not an identity. He does not try to be right. He tries to be disciplined. He survives bear markets, resists overconfidence after success, and proves that the hardest part of investing is not analysis, it is behavior. This is why the lessons in this book still matter today. Technology has changed, speed has changed, but fear, greed, and ego are exactly the same. If you take one thing from this book, let it be this: your edge is not what you know, it's how well you control yourself. If this breakdown helped you understand how real market discipline works, hit like so more investors can see it. Subscribe if you want clear, no hype summaries of the most important investing books ever written. And comment below, do you think discipline matters more than strategy in the stock market? Thanks for watching, and I'll see you in the next breakdown.